In this week's video, we'll review the latest charts and data to help us answer the question, is it time to underweight tech stocks? Given the S&P 500 hit a new all-time high earlier this week, the number one question for us is, are we allocated properly? The charts that follow will summarize another comprehensive review of all of our options. 388 ETFs. We looked at them from numerous perspectives on numerous time frames. It's a very long-term chart of physical gold relative to the S&P 500 going back to 1968. Not much has changed here. We still have this region on the right side of your screen over here that represents an area of potential resistance for the ratio. If we go all the way back to this period here, let's say in 2014, 2015, been a lot of volatility between the two assets, or more specifically asset classes, physical gold relative to stocks, but there's no resolution here. Thus, there's nothing on this long-term chart in front of us that says we should be making any radical changes to our current allocation in gold, nor our current allocation in the S&P 500, at least on a relative basis. Having said that, this chart, this is gold mining stocks, GDX, upper left-hand corner of your screen, relative to SPY, the S&P 500. If you know asset class history, precious metals started to underperform in 2011 with this relative peak here, upper left-hand corner of your screen. If we attach an anchored weighted average price line, this blue line here, to that peak, you can see we've come right back to that level. You can also see from a horizontal perspective, this was an area here that acted as resistance in the past, in calendar year 2020. This was also an area of past resistance in calendar year 2016. We also had a stall in that general region in 2013 and 2014, and we're back to that same region in the present day. Unlike this peak here, this peak here, and this peak here, the present day chart, early 2026, has cleared both the light blue and the orange lines. We couldn't do that here, couldn't do it here, and couldn't do it here. So that represents a subtle shift telling us to keep an open mind about this base that dates all the way back to 2014-ish, potentially breaking out to the upside. And that may happen very, very soon. It just hasn't happened yet. This is physical gold in the ETF world, GLD, relative to SPY. Most clients have both positions in their portfolios. Unlike GDX, which is broken above this cluster here, the AWAP lines relative to the S&P 500, it's above these lines. We haven't broken above it yet on the physical chart. We also remain below this relative peak in 2020, this peak here in 2016. That stall area is not as pronounced back here in 2013 and 2014 relative to the GDX SPY ratio that we just covered. Another positive development for GLD relative to SPY, notice how the AWAP lines are starting to flatten out. It's easier to picture them turning up in the future. Compare the slope here with the slope back here and the very pronounced negative slope back here in 2014. Now, we're covering the best of the best options, the strongest options that are challenging trend flips relative to the S&P 500. European financial stocks, European banks, have been strong for quite some time. Our consolidation box, again, in blue. And like the last chart, the AWAP lines, compare the slopes back here to the slopes here that are starting to try to flatten out a little bit. There's also one subtle shift on this chart that's favorable for European financials, telling us to keep an open mind about a move in this direction. A lot of foreign ETFs made a high earlier in 2025 and have not exceeded that high later in 2025 or early in 2026. That's not the case here. EUFN in the ETF world has made a new high recently above this high here and this high here. Thus, if you're a client, it wouldn't be shocking to see EUFN in our portfolios at some point in the near future, but we still need to see more. It's a period of indecisiveness in here. We'd like to see this chart at least get out to this white space in this region here before considering a very small addition to our portfolios. It's also noteworthy. When we review 388 different ETFs or 388 different buckets that we could allocate capital to, we're talking about an opportunity cost analysis. The question isn't, especially in a bull market, if EUFN is attractive. The question is EUFN more attractive than U.S. large cap growth stocks? And unlike the last chart, where EUFN made a new high in this region here relative to SPY, this is a discernible lower high here on the EUFN SPYG chart. So we had a higher level of conviction in European financials relative to U.S. large cap growth stocks in early 2025, but that reversed when the tariff news became less bad. We're climbing again, but haven't exceeded this high, and we're also well below these AWOP lines here that are still sloping downward. They haven't flattened out as much as the previous charts that we just looked at. So the takeaway here is you're in no gigantic rush to dump SPYG in favor of EUFN. You'd be more apt to possibly allocate some SPY-like assets to EUFN while keeping SPYG in the portfolio. Let's stay with the foreign ETF theme. Since Q1 of 2025, down here, lower right-hand corner of the blue rectangle, EWP Spain, a diversified basket of Spanish stocks, relative to SPY has been moving from the lower left to the upper right. EWP in the short run has been outperforming, as it did here during a counter-trend move, as it did here during a multi-year counter-trend move, but then it resumed the downtrend. So breaking out of this box here is constructive, and it tells us to keep an open mind about EWP SPY continuing to outperform. But we've got this band here of AWOP lines that tie back into this cluster here, into this cluster here, and here, that thus far appear to be acting as potential resistance. And from a foreign stock perspective, we'd really prefer to see broad foreign ETFs outperforming SPY rather than a few individual countries that look very, very strong. Spain looks pretty good. EWP and EWI, Italy, they both look pretty good. And a lot of that has to do with heavy weightings to financials. So we would probably prefer EUFN, European financials, over EWP or EWI. But we'll see how it unfolds. Another thing to keep in mind, there's not really a lot of institutional buy-in in EWP. Its average daily volume is around 700,000 shares. That pales in comparison to SPY, XLK, XLF, XLI. But it's not insignificant. There is some institutional support here, but if we were to take this exact same chart, but this time look at foreign stocks with the exact same AWOP lines, so this is global stocks, ACWX, X the United States, so foreign stocks. ACWX is still below the less bad tariff news high here that was made in Q1 of 2025. And it's really not even making a run at these downward sloping AWOP lines that were the same anchors that we used on the EWP Spain relative to SPY chart. Forget all of this. Just look at the ratio. That's a downtrend. The last thing it did was make a new all-time low in late 2024, early 2025. It hasn't made any significant higher high yet. It really hasn't done much to even threaten this downtrend here on a relative basis that began in Q1 of 2018. To do that, you would have to exceed this orange line and this mustard-colored line. If you've been following geopolitical events, it's not shocking that ITA, U.S. Aerospace and Defense, relative to the S&P 500, looks like it's experiencing a constructive breakout here. However, if we come back to this relative peak in 2018 and draw a trend line, we still haven't broken this downtrend from the prior peak. But this is a really good look here. This is very, very similar to the look of SPYG, U.S. large cap growth stocks, relative to the SPY, or XLK relative to SPY, that prompted us to become buyers in recent years. Like EUFN, it wouldn't be shocking if a very small position of ITA ended up in our portfolios at some point this year. That's still to be determined. We all know we want to own things that move from the lower left to the upper right. And the trend in large cap growth, this is Russell top 200 growth relative to SPY, is still moving basically in that manner. The last thing that it did was make a new all-time high late in 2025. We're still trading above the breakout level from this period here of prior resistance in 2020. In this period here of prior resistance in 2021. So as long as we hold the dotted horizontal line here and stay above these rising AWOP lines, probably just want to remain patient with these positions. Our interpretation of this chart would change if the ratio moves into this area here. That may happen very, very soon. It just hasn't happened yet. There's a lot of talk about overweighting XLF, overweighting XLI, industrials. This is a stronger ETF. This is KBWB. It's even more attractive than XLF. But if you look at KBWB, which for the most part is large money center banks and financial institutions, big boys, relative to the S&P 500, it's in a downtrend. Last thing it did down here in 2023 was make a new low. Hasn't exceeded this high here, and we're below downward sloping AWOP lines tied to this peak in 2018. It's a lot easier to buy an ETF like this with average daily volume of 2.3 million relative to something that's trading a minimalistic 85,000 shares a day, which tells you something about the wisdom of the crowd. But right now, this looks like a counter-trend move within the context of an existing downtrend. Having said that, we have to be open to these AWOP lines flattening out and turning up and the ratio moving out here. Again, the question is not, is KBWB attractive in isolation? That doesn't really tell us much. We need to know, how does KBWB look relative to some of the best long-term options, including SPYG, large cap growth. And you can see we're really not even making a run at these lines up here. We have made a new high here relative to this high. This is Q1 of 2025. That's constructive. But right now, really all that tells you is the outperformance could continue, but there's this area here of potential resistance that would need to be broken or exceeded here before we can say this downtrend is in jeopardy of being flipped from a downtrend to an uptrend. This is physical silver relative to the S&P 500. Remember earlier we said if you know your asset class history, you know precious metals started to underperform in 2011. It's relevant and important that this blue AWOP line that's tied to this peak back here is being challenged, and we're above it right now. That's a really good first step, telling us to keep an open mind about SLV, SPY getting into this region here. However, there's additional obstacles, potential obstacles ahead, including this area back here from 2007 and 2008 that acted as prior support. What once acted as support acted as resistance in 2016, and we're still below that region in the intersection of these AWOP lines from that period. So we'll see how this unfolds. We're still below this peak here. We've exceeded this peak item on the bullish checklist. In fact, if we drew a trend line down here to this low, we've broken that trend line and are doing things that we haven't done in quite some time. There's no question SLV is strong, precious metals are strong. The question is what's going to happen here in the short to intermediate term. Here's another reason to be skeptical of doing anything with tech. Look at semis relative to the S&P 500. What is this ratio doing? On Friday, January 9th, 2026, during the session around lunchtime, it's hovering right around an all-time high. That really doesn't look anything like this period of underperformance in here for tech in general that ended with the tariff low here in early April of 2025 that we covered in last week's 2025 review video. This is a healthy looking chart. It's very, very difficult to think of tech being in trouble with the semi chart up here. Why? Because it's all interconnected. You can't do much with a semiconductor in isolation. So there's a lot of other companies involved in the hardware space and the software space and the implementation space. The last thing this ratio did was exceed this area of prior resistance from July of 2024. All of the AWOP lines are upward sloping, and we're above all of them, and we're holding this breakout and have made a higher high after this period of indecisiveness and what now looks like relatively healthy consolidation after the breakout. Earlier in the video, we showed a chart of ITA relative to SPY that unquestionably was doing some really, really nice things, saying that ITA could continue to outperform, at least in the short to intermediate term, and maybe much longer than that, especially given what we know about global politics right now. But if we take the same ETF, ITA, and divide it by semis, really hasn't done anything. It's been in a downtrend here since that less bad low for tariffs here in April of 2025, making a series of lower lows and lower highs, and really hasn't done anything to exceed in a confidence-inspiring manner any of these AWOP lines on the right-hand side of your screen. So based on the chart in front of us, there's really no compelling reason to dump SMH or cut your allocation to SMH in favor of ITA. Relative to SPY, that might be a different story. The last thing the chart of the triple Qs relative to SPY did was make a new all-time high after basing and moving sideways for almost 5 years. This chart is clearly moving from the lower left to the upper right. That's in stark contrast to a lot of the charts that we've looked at, recent leaders that are moving from the upper left to the lower right and trying to flip their trends. Yes, there's been a period of underperformance since this new high here in the upper right-hand corner of your screen, but we're still above this AWOP line tied to that tariff low. We're still above this AWOP line tied to the prior high, and we're still above the AWOP line, the red line, tied to this low here in early 2023. And the ratio made a stand there in 2024, again in 2025. Our interpretation of this chart would change significantly if the ratio moved back into this area. Concerns would also increase if we gave up this level, and this level, but not significantly in the short run. Now, before Friday's NFP report, the bond market was pricing in about an 11% probability, a very low probability, that the Fed was going to cut rates. After the non-farm payroll report, or the monthly labor report that was released Friday morning at 8:30 a.m. Eastern Time, that probability dropped even further, from 11% down to about 3%, and then it bumped back up to 5%. So if you're investing or playing, let's say, the small cap game, the financial sector game, or even economically sensitive industrials, if you want leadership to change, you probably want the Fed to cut rates so things will broaden out. That would be good for XLI, XLF, RSP. Now, after the report on Friday, at least intraday, tech was performing quite well. And there's nothing on this chart here that's particularly alarming. This is VGT relative to SPY. The last thing it did, like the other charts, is make a new all-time high. And there's nothing alarming in here about this underperformance. We have this area all the way down here of potential support. So that underperformance could continue, and it still wouldn't be overly concerning. If this breakout fails and we drop below these lines and drop below this upward sloping AWAP line, the blue line tied to this peak back here in 2022, then concerns would increase. We know markets like to overshoot. It's exactly what we did at that tariff low, the less bad low. This turned out to be a head fake. A short stay tends to be bullish, and it was. So logically, if we were going to underweight XLK and overweight XLF, it would probably make sense to have that trend at least show some improvement prior to doing it. It's shown a little bit of improvement, but really nothing to write home about. It's hovering around a new all-time low just a few short weeks ago. And even if we exceeded these lines here, guess what that would look like? It would look like a counter-trend move within the context of an existing downtrend. A counter-trend move within the context of an existing downtrend. A really good first step would be to exceed this purple line here and at least get into this ribbon. Second step would be to get above the ribbon. The third step would be to clear this downward sloping trend line that dates all the way back to calendar year 2020. There's no compelling reason trend-wise, observable evidence, to dump XLK and buy XLF. Everything we said about the last chart applies to this chart. This is XLI relative to XLK. If I decided to overweight industrials and underweight tech, we'd probably want to see more prior to doing that. We trade the chart in front of us, and the chart in front of us still hovering around an all-time low and has numerous areas here of potential resistance above. It is still trading below the downward sloping trend line tied to this level here in calendar year 2023. Haven't even exceeded this low here from 2021. What once acted as support, may now act as resistance in that same area. Our interpretation of this chart would change significantly if this ratio can get out into this area here. And that may happen very, very soon. It just hasn't happened yet. The same concepts apply to RSP, the equal weight S&P 500 relative to XLK, the tech sector. Dating back to this high here in 2023, that ratio has been moving from the upper left to the lower right, and it recently made a new all-time low in Q4 of 2025. Remember we said precious metals started to underperform in 2011? Well, XME started to underperform before that. It has a high back here in 2008, and if we attach the AWAP line to that important high, you can see the ratio is still below it. Having said that, this is a nice constructive look here. We're trying to break out of a multi-year base that goes back to 2015. Why is it possible that precious metals, GLD, SLV, and a metals-related ETF, metals and mining, XME, a little bit broader in terms of the metals that it has exposure to, what could be the fundamental reason for them improving? Well, debasement of currencies. Governments around the globe are over-indebted. It's not just the United States. And they typically try to inflate their way out of debt, just as they've been doing in recent years. One of the ways to hedge yourself against inflation is to own precious metals. And that can be expanded to more general commodities like copper. So we always have to be open to making changes, But we don't want to jump the gun on anything either. Keep in mind how this chart is moving. This is the upper left. This is the lower right. If we were to draw a trend line down here, this attaching to this, we've not exceeded that either. So if you get out into this area here, things get very, very constructive. And we should be open to that because this is a subtle shift. We're higher here. We're unable to do it here, 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 or here. So this is a subtle and bullish shift telling us, adding to our metals exposure in some shape, form, or fashion, whether that be GDX, GLD, SLV, XME. It's quite possible. The hurdles that you have to clear and the standards should be extremely high before we disrupt compounding in a bull market. All things being equal, if you can't convince yourself to make a change, do nothing, trade less, and stay with the bull. There's nothing on this chart at 12:07 p.m. Eastern Time on January 9th, the chart of the S&P 500 index, that tells us the bull market is on the ropes, and we really don't have any evidence in hand that says any of the long-term leadership trends have flipped either. Are many of them potentially in jeopardy of flipping? I think that's fair. And that's why we all know. If any of this is going to be helpful in the coming days, weeks, and months, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.